Video on risk reward. So risk reward is the absolute most important part of your trading plan. A lot of experienced traders will tell you that you could be the best trader in the world, but if you don't correctly implement risk reward, your trading results will hinder essentially. If you're not implementing risk reward long term, your account will not grow as it should. You might even blow an account. So if you implement risk reward from day one continuously, you will never blow an account. Okay, so risk reward is basically you're risking X amount to gain X amount. So the way I like to do it is a minimum risk rewards, or RR, of 1 to 3. So that means you're risking X to gain 3 times that. So let's say you're risking $100. You're risking, so let's say risk for a trade is $100, just for this example, negative 100. Your minimum gain, so your RR, your risk to reward, your minimum reward will be, in this case, $300, because you're risking 100 to gain 3 times that, 300. And the benefit of this is, obviously there's going to be times in your trading career where you might have some losses. So the benefit of this is now your account is up by $300. So if you risk $100 every time, you can then lose the next 3 trades, so 100, 200, 300, and be back to exactly where you started before you took this trade, because all you would lose is that profit, right? Whereas if you're doing like 1-to-1s, 1-to-2s, you're not going to have that much of a buffer long term, right? So that's why minimum 1 to 3 is what I recommend. So how I like to view everything in trading with risk reward and risk management is through percentages. So let's say, for example, you have a account size of we'll pick a nice round number, $10,000. Okay, I like to do everything as percentages as 1%. Okay, so let's say you have an account of $10,000 and you're risking 1%. So 1% of that equals $100. So what your goal should be is to, if you keep your risk the same, well, first of all, if you keep your risk the same, therefore you're always risking 1%. Eventually that 1% is $100, and then that 1% will turn into $150. And then as your account gets bigger and bigger and bigger, or you get funded through FTMO or any of these other funding companies that are out there, or you continuously reinvest into your account, that 1% of $100 turns into $200, and then $300, and then $400, etc., etc., etc. And yet your risk never changes. Your account grows, but your risk doesn't increase. So what I like to view is a minimum, as I said, a minimum 1 to 3. That's an absolute minimum. You can get 1 to 5s, 1 to 10s, 1 to 20s, 1 to 30s. Obviously very, very difficult. They take much longer, but a minimum 1 to 3 will always keep you ahead. So this needs to be the absolute basic rule of when you take a trade. Is you're risking X amount to gain X amount. Now you can risk 2%, 3%, 4%. It's up to you. I like to do 1%. That being said, when you have a smaller account, you might want to do maybe 3%. I don't find it healthy to go above 3% risk. I think it's a bit much. But that being said, if you were to risk 3%, you'd have to lose like 33 trades in a row to blow your account. Okay, so I believe 1% is the best way to go, and it's definitely worth practicing. So how you calculate your stop loss and your risk. All right, so we're gonna go to my FX book, and we're going to position size. Okay, so my FX book position size calculator. So let's say you're taking a trade on Euro USD, and let's say, as I said, your account is, in this example, $10,000. Right, you're going to, in your risk ratio, see how it has percentages, you're going to hit 1%. And let's say you figure out where your entry's at, you figure out where your stop loss is going to be, which again, I'll cover how to calculate stop losses and entries in other videos. It'll all become very, very simple. So let's say you figure out your stop loss, and for this trade is going to be 25 pips. So your risk right here is $100. You don't need to worry about your units. So your risk is $100. As it's 1%, it will always be $100. And your lot size that you'll enter on your MetaTrader is 0.4 lots. Now let's say you're taking the exact same trade, exact same account, exact same risk, but let's say you had a bigger stop loss of 30 pips. See how even though your stop loss is bigger, it's still $100, because it's why? Because it's still 1%. But the thing is, because it's a bigger lot size, because it's a bigger stop loss, your money, your $100 is spread out over 30 pips rather than 25 pips. Therefore, you're gonna have a smaller stop loss of 0.33 lots. So you would enter that into your MetaTrader as your entry. Okay, so this is all this is all through my FX book on the position size calculator. So back to your chart. So let's say we're gonna take a few trades as an example. Okay, so let's say you're taking a trade here, and you're gonna take a sell. Let's say you're monitoring price at this level, you figure out, okay, there's a nice amount of rejection, there's patterns, etc. There's a good amount of exhaustion. So you would take an entry, and let's say in this example your stop loss is 15 pips. So what you would do is you put on your sell tool, and you would double click it. You would figure out where your entry is going to be, and then you would go to your stop level and see how it says ticks here. You would put in, let's say you want to do 150. Whoops, 150. That equals 100. That equals 15 pips. Okay. And then your first target is where? Is going to be down at your next level of structure. So in this case, you're risking 15 pips, again, which is 1% for this example. It should always be 1% unless you decide to risk more, to gain, so 15 pips to gain 82.3 pips. All right, so 15 pips to get 82 pips is a 1 to 5.49. So that means you're risking, again, in this example, you're risking 1% or 1 to gain 5.49. So as you see price in this instance played out, and you would have closed price down here. So now your account has grown by 5.49%. So technically you could lose the next 5.49 trades back to back to back to back to back, and you'd be back to where you started here. This is the benefit of risk reward. So another example here. So let's say we took a buy down here. You're watching price at this level, and let's say for this example you figured out you want to do a 20 pip stop loss based on structure and your entry. You want to do 20 pip stop loss, and your next target is where? Here. So see how it's the exact same trade pretty much, although obviously we're buying it instead of selling it, but because your stop loss had 20 pips instead of 15, the risk reward is a 4.09 instead of a 5.49. Why? Because a wider stop loss will reduce your risk reward, because it's, again, you're risking more pips even though it's still 1%. Okay, so let's say for example here we have a 20 pip stop loss. Let's say for example your target was 100 pips. So that's risking 20 to get 100. See how it says 1 to 5? Because why? Because 20 times 5 equals 100. Okay, so let's say it's 200 pips, for example. See how it's a 1 to 10? Why? Because 20 times 10 equals 200. That's how you work it out. Okay, so in this instance, you'll see that price obviously broke above structure. So therefore, you would take it to the next level. You see it broke above this level. So this 1 to 4 trade became a 1 to 7, which then became a 1 to 20.67. Again, risking 1% to gain 20. All right, so let's say again you were risking 1% of a $10,000 account, which was $100. So the max you could lose in this instance was $100, right? No matter how far down this went against you, you would have only lost $100. Why? Because your stop loss is what prevents you from losing more than what you want to risk. Okay, so let's say you took this trade, so you would have done risking 1%, which is $100 of your account. You would have gained 20.67. So you would have gained $100 times 20.67, which is what, I think $2,000. So you would have gained, risk $100 to gain $2,067. Whereas down here, you would have risked $100 to gain 5.49, so $549, right? So now you could lose the next 20.67 trades back to back to back, which obviously no one's going to lose that much, but it's about giving yourself a buffer and growing your account steadily. So let's do another example. Let's say you were watching price at this structure here, and price, let's say you did a 30 pip, let's say you did a 25 pip stop loss. Again, 250, 25. Again, it doesn't need to be 25, it could be 22. I like to do everything in 5s, 10s, 15s, 20s. That's just how I like to do everything. That's usually how it should be done. And the price obviously came down here, your target. Obviously, you would have targeted this level first and then here. So you're risking 25 pips to gain 140, which again is a 5.63. So even though, for example, down here, this trade was a 5.49, it was only 80 pips, risking 15 to get 80. This like risk reward is a 5.49 only for 80 pips, whereas this is 140 pips at 5.63. Why are the risk rewards so similar? Because this has a bigger stop loss. You'll find that if you watch that 5.63, if I was to make this down to a 20 pip stop loss, see how that 5.63 becomes a 7? Even though you're risking the same amount, because your stop loss is tighter, your risk reward increases because your lot size is going to be bigger. So back to the calculator, if you were to do a 20 pip entry on USD CAD, for example, see how it's a 0.63. Now let's say you're going to do a 15 pip entry, your lot size is going to be bigger. So for every time it moves up a pip, you're gaining $8.4. So this right here, this lot size is $8.4, $8.40 per pip. So if it moves up a pip, you gain $8.40. If it moves against you a pip, you lose $8.40. All right, so let's do another example. Let's say 25 pips. Here, $5.10. So if price moves up 2 pips, you're now up $10.20. If it moves against you 2 pips, you're negative $10.20. Okay. Let's go with something a bit bigger. Let's say you have a $100,000 account and you're risking 1%. So you're risking 1,000. You're risking $1,000, again, just 1%. And your lot size right here is 6.33. So that's $63.30 per pip. So every time that price moves up, you're gaining $63.30 per pip. So if you get 100 pips, right? That'd be 100 pips times $63.30. You would gain 6,330. So that would be a 1 to 6.3 trade, because it'd be 1 to 6, right? So because you'd be gaining 100 pips. So hopefully guys, this makes sense. Risk reward is very, very important. Again, 1 to 3 should be the minimum, but as you can see, you can get 1 to 5s, 1 to 20s, 1 to 7s. So if you're looking at a trade right here, let's say for example here, see how this is not a 1 to 3, it's a 1 to 2.6. And based on your analysis and your entry and your target, you see that it is a 1 to 2.6. You would not take this trade. But again, if it was a 1 to 3, by figuring out where price is going, you would understand it's going to go down to here, be a 1 to 7. You would take that trade. So you always want to make sure you're getting at least a 1 to 3. That way your account is obviously growing and you always have that buffer. Anything below that, I highly recommend you avoid doing. If you guys have any questions, please let me know.